Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny, and holy shit, this week was wild. We got that massive CPI kind of came in under expectations, and the market just took off like a freaking rocket. Dylan and I kind of disagree about what's going on and what that really means for the overall health of the economy, the stock market. We're gonna get into a little bit of a debate about this.
Disagreement.
Two stupid guys trade stocks.
All right. Before we get into the presentation, Vinny thinks we're definitely going down, right? Most likely.
Overall, yeah. We'll talk about it a little bit more,
Okay.
but yeah, we're
And
not done yet.
who've previously been very bearish, now saying we need to reevaluate where we are because this is fairly unprecedented. Now, here's what happened the last 2 days. Vinny, what happened on this day?
CPI numbers came out, and they came out below expectations, which was very, very welcome to the market. We've been getting sick and tired of seeing these ridiculous numbers,
Right.
but now they got a positive news.
Two big things in this chart. We closed the prior day at 373, opened at 388. Already a ridiculous movement. And then just friggin' went straight up. Like, just absolutely.
Wow.
Okay. Following day, tested lows, almost no volume came in, so we just went straight back up. This big scary bar, this is a volume bar. Institutional investors, institutional investors, when the volume is this high, that means there's institutional buying, okay? Me and Vinny, or what's that term? I'm blanking out the term.
Retail investors.
Retail investors cannot put up this volume. We could put up like this little bit right there. Okay, we can't do any of this. This was an institutional move on conviction after a jump up. So we're gonna get into
To steal a scene from Braveheart, some men are longer than others, though. Okay. All right. So the real question here is this bear market officially over with this mass rip your face off rally we saw this week? Okay. So, yeah, I've been reading this book. I'm not quite done with it. Once I'm done with the book, I'll actually probably do a summary video about what I thought. But this is Paul Volcker's book. He was the Fed chairman back in the 1980s. He was the guy that was ultimately responsible for not only transitioning away from the gold standard into fiat currency, but breaking inflation. Right? And this is the quote here is actually from Chairman Powell's Jackson Hole speech this year. Okay, remember that one back in August that the market just absolutely hated. So if you notice right here, we have to just keep at it until the job is done. And you notice the reference here? Yeah, that's the title of Paul Volcker's book. Huh? Yeah, nice. Pretty nice, huh? Kind of funny how that works out. Basically, the whole idea here is that he's saying that you have to get past the point where there's clear and convincing evidence. If you're too dovish, you're going to run into more problems than if you are overly aggressive. And that is, he's telling you where his stance is and that his bias is going to be towards being too harsh to the market. All right?
Got it.
The other thing we have here as a talking point, Michael Burry, right? Our patron saint of this channel practically at this point, I guess you could say. Do you remember this tweet where he talked about the fact that inflation, it doesn't just, kind of hit a peak once. It tends to have a couple of different spikes, okay? And that it tends to stay at that elevated level a little bit longer, right? So I'm not saying that we're still headed towards kind of horrible things. That this week's print, I think, definitely decreases the risk of us heading towards really bad scenarios as far as like hyperinflation, stagflation, that sort of stuff. But the point is that this was a wildly early celebration. This is when you're at a strip club and you have a little bit of an accident in your pants before anything even happens.
It's fair, but one thing to be noted on that chart, can you go back real quick? Yeah. Between the peaks is 5 years per peak there. So just putting that out there, because the stock market didn't bottom for 5 years. It went up. So
yes, the entire 1980s was a complete and utter disaster as far as like stocks go. Yeah, it's funny when you look at this chart. This is the Buffett indicator here, right? So this is a historical correlation of GDP, gross domestic product, the total production of the U.S. economy compared to the stock market. And if you notice in prior episodes where we've had kind of major, recessions or kind of readjustments in the market, the bear markets, if you will, we actually got back down below this normal historical trend line, right? This is the dot-com crash here. We got below that historical trend line. This is the 2008 crisis. well below that standard trend line. If you look at the COVID crash, we almost touched it, but not quite. We're
That's close
still
enough.
at a relatively elevated valuation compared to historical trend lines, which some people even argue against, because remember, this historical trend line has an upward slope, meaning that the market is always becoming, kind of more expensive comparatively to the actual production of the economy.
Okay. Okay.
This is another article I wanted to bring up here. This is from, I think it was a Market Watch, but it's do Federal Reserve rate cuts signal bear market bottoms? All right. This is looking at the prior kind of bear market cycles, and they looked at the delay between when the Fed actually pivoted. So when the Fed finally started easing rates, all right, we haven't even seen that happen yet. We're still probably going to get another 50 basis points here in the beginning of December. All right. So we still have a few more months before we even begin to see the possibility of a pivot, probably, because they're probably going to plateau at some point. You're looking at years, basically, before you actually see the market bottom. So this is 645 days between when the Fed pivot and the actual stock market bottom was.
When you
You're
say
looking at
Fed pivot,
538.
do you mean the first time they dropped rates to the bottom
Yes.
of the market? Okay.
Yes. So when they're finally going into a stimulated kind of a economic stance, you still have another 6 months to 2 years probably at that point. I know
Okay.
that's hard to trade that because it's such a long time horizon. Okay,
It is.
but my point is just we're still not done in the grand scheme of things. 538 days here for the 2009, like the Great Recession, and then this one right here they were starting to do a rate hiking, kind of hiking cycle before we had the whole COVID pandemic, so this ended up being a relatively short one of 236 days. But that got really accelerated because of the pandemic. So that one's on the short side compared to the other two. So I think you're looking at something much longer than that.
When was our first rate cut?
It was in the actual. I forget exactly when the hike. I mean the cut was in this time period. That one's kind of hard to extrapolate out though. The market in general, I would say. The other kind of point I wanted to make here is we're looking at unemployment, right? We've seen a lot of headlines over the last week about these major tech layoffs, right? But that's going to be something that's going to take a little while to have a full effect on the economy. And when you look at historical kind of relationship here of this increasing unemployment rate to the actual market bottom, we're still at a kind of a phase where we haven't even begun to go up in terms of our unemployment rate and rate of change. And that look at this one right here is kind of very pretty in terms of how well that lines up. The rate of change in the unemployment rate basically marked when it started to plateau initially there, it basically marked the 2009 kind of market low. So that's a lagging indicator, so it's not a great one, but I'm just telling you we haven't even begun to see the turn that would head us towards topping out pattern.
Okay.
And finally,
I have that number here, by the way. It was December 20th, 2018. Oh, just kidding. Forget I said that.
It's all good. But generally, this is Carl Icahn, investing legend. But there was a headline from him on CNBC this week about how saying, in his opinion, the bear market is not over either. And that's why I wanted to make that point. Is this is kind of what initially spurred this? Is that we still have the yield curves that are inverted, both the 2-year and the 10-year, and then also the 10-year and the 3-month, which is like the Fed's preferred kind of an indicator of a pending recession. That was it for my presentation. You want to show us yours? See what your counterpoints are here?
Yes, sir. So that one, it worked. I was kind of nervous about that.
Right. Love it.
Yeah. So, what I'm saying is we need to reevaluate where we are, especially me, right? Because I have June SPY and Q 2023 puts, and then 2024 June SPY puts. Not too, those are pretty far out.
Yeah.
Now, this is to reinforce Vinny's point that no one knows. Okay? So these are all like important people, if you will. The market is likely to hit a bottom before inflation eases and the Fed stops raking heights, but it'll be extremely difficult to tell. That's Paul Short's. He also said, we have no idea. What?
Okay.
Yeah. And then, despite some signs that the bear market could be nearing end, the bottom will likely be triggered by a shock. I think he means capitulation. Here's a lot of people saying that. My favorite was, you don't bottom when the VIX is at 30. I thought that was kind of funny because I said that earlier.
Interesting.
And VIX is quite low, so that's a counterpoint to mine, all right? Now, correlation does not equal causation. Okay. The big thing that people forget when we're looking at the market is there are a million variables. You can look at the interest rate distance. You can look at whatever you're trying to do. Every crash is fairly unique. Okay. So let's just taking that correlation, not causation. We're up against midterms right now. Okay. Historically, the pre-midterm 12-month average for the S&P return is 0.3%, meaning it sucks. The year after the election results are in is 16.3%, double the normal SPY return. I don't know why that happens, but it does. So right now, we're coming up on that 12-month period. And if you look at Vinny's point of how long these usually take, adding 12 months gets a little bit rough because that means one of these has to fail. Okay?
Very true.
It's not a great time.
Did you look at all about like what the congressional or federal kind of leadership is made up of in terms of parties and that sort of alignment and what the returns are? Have you ever seen anything about that?
No, you mean if it was like a full Democratic House and Senate? No, it was like there's 15 of those. I was like, it's gonna take too long.
Yeah. There's not enough data, but ultimately the best is that a Democratic president with a split Congress is like the best indicator for market returns, which is actually looks like we might get. We might get a Republican House and a Democratic Senate, which would be like the best case scenario. The actual mixing of the Senate is the number one thing that you want to have because it's nice. It adds a little bit of deadlock to Congress, right? So therefore it makes it a little bit less likely that some massive, crazy piece of legislation gets pushed through, which is something that markets hate. So I think that's a good sign.
It is. That's true. Now, what I want to point out here, this is the 2008 crisis, okay? This red arrow is where the first rate cut was, okay? Now, we were chilling at like, I think it was 6.5, 7%. And then the red arrow down here at December 08 is the last rate cut they did, effectively like almost zero, or like as close to zero as you can get. It's 0.25. The bottom of the market was 2 months after the last rate cut. Okay? That's important for my point. Now, September 18th, that was the first cut. They did not have a rate hike until 2015. They kept those rates low for 7 more years. Okay?
Yeah, that's crazy.
Now let's look at the dot-com bubble, just to reiterate my point. The red arrow here. Can you see my mouse, Vinny?
Yeah.
I barely know how to work this system. The red arrow here, once again, was the first rate cut. I want to say we were at 6%. I can look that up. Oh, yeah, 6.5. Okay? First rate cut. This peak up here was the height of the market, so right before the crash. Okay? So from this red arrow to this blue arrow, we went from 6.5 to 1.75. Okay? About 1 year. That's a lot.
Yeah.
Now, for the next year, we did one rate cut from 175 to 125. We're still cutting. All right? We hit the low of this red right here in July 02. That's when the actual bottom was. If you read later, it's like October 02. It was by like literally 0.5. So like, who cares? We had another rate cut another year later, or less than a year later, by 0.25 points. Then we started increasing. All right?
Interesting.
That's important for what I'm going to say. Also, Philly's lost, so I'm going to win this argument.
Yeah, I love it.
Doesn't even matter. Now, the reason why this matters, there we go. Here is our SPY. Let me get rid of this. Unfortunately, we were chilling at low rates when this whole thing already started happening. So I have this up here. Where's my mouse? 2000. When was COVID? 2020? Right?
Yeah, March of 2020 was when the market low.
Before COVID, we were chilling at 1.75. So we just cut immediately to April 29th. This is not the same situation as those because there were no rate cuts. We were cut. We were dead. We had nothing to cut. Okay? We did not start going up from that date until March 16th, 2022. So I think it's unfair to compare pivots or rate cuts when this happened at a historically low Fed rate market.
Yes. Very
Before we
true.
were at 7% going to down. We were already screwed, and now we're going back up.
Mm-hmm.
I think it's important to consider. Now, all of this is all speculation. Everyone knows. You can see my SPY graph here, right?
Yeah, I can see
All
a
right.
SPY graph.
This line is the only line that matters. Everything Vinny and I said doesn't matter at all.
Sure, if you're a market technician rather than like someone that looks at macroeconomics, I guess. Yeah.
It doesn't matter. It doesn't matter. This is the 200 moving average. All right, we're coming back up to hit it. Whatever happens here is what matters. For people who are short with me, I'm sure you're not having a good time because I went up 40% to down 38% in a matter of like 3 days.
Yeah, that's wild.
It depends on what happens here. This is either an adding point or a come to Jesus, get out immediately point. All right?
Interesting.
We're going to have to see what happens. Either way, I think this is a very complex issue because when people talk about the bottom happens after the pivot, it's not the same. We were already low. So our pivot was up, not down. Make sense?
No.
So the people say the bottom happened after the Fed pivot, meaning it went from increasing rates to cutting rates,
Yes.
right? For us, we were already cut down to you can't cut anymore. So the pivot is them going up, not down. Whereas previously in all other recessions, or not recessions, bear markets, it was up to down. We're going down to up.
No, but we'll eventually reverse. That's the argument, is that the Fed will increase rates. They will hold it at a plateau. Then at some point, the market they will see need to stimulate the economy. They will pivot at that point.
Okay, so you're
And
saying the
then
pivot hasn't happened.
the pivot hasn't happened.
Okay, all right. If you look
That's
at it
what I'm
that
saying.
way, I mean, you would have to buy options for like 2027.
Yes, that is really where the crux of this comes to kind of bear, is that there's so much time left before you truly would see a market bottom, that being short, tactically going for that bottom, I don't know if it really makes sense. Now, yeah, I'm a dollar cost averaging kind of buy when I can kind of guy, and I'll still use sometimes options trades to make a little bit of money like here and there, but I think overall the bear market bias is my argument is still going to be continuing for quite some time. The other kind of point that we haven't really got into is talking about the Fed balance sheet. That peaked at over
Yeah.
$9 trillion.
It's a lot.
Right? And
It's
they've
about
been
time.
selling off assets, but they still have. I was like 8.6 trillion. I think last time I looked, they've lost $400 billion in assets that they've sold from their peak, something like that. They have a long way to go because like COVID stimulation, they were hitting at about 4.5 trillion. So they still have another $4+ trillion to sell before they get back to pre-pandemic levels of assets in a balance sheet.
But they could do that over a course of like 7 years. They could do that. I mean, they could do that. They could hold, just because we were at pre-COVID of 4.5 trillion, the new one could just be 6, right?
True.
There's no way to know. But
Yeah.
let us know what you guys think. If anyone asks why the 200 moving average, we have multiple videos of me showing why it's the most magic thing on the entire planet. It's beautiful. But yeah, let us know what you think. If you need to reevaluate, or if you're bearish like Vinny. I'm still bearish, but all right. Bye, guys.
See you in the next one.